analysis is a part of predictive analytics, where we try to understand the behavior of a time series and use it for forecasting. Now, any series, like it could be sales, it could be prices, it could be production, any series which you need to know future values of it, you do time series analysis. So this is a basic introduction to time series analysis to give you the basic concept of time series analysis, how it is used, and how some of the important components, basic components, not the advanced ones, the basic components of time series are to be estimated. So time series analysis is mainly used for forecasting. So it represents one of the oldest and the most practical applications of predictive analytics. So we have 4 types of analytics, of which predictive analytics uses time series analysis a lot. You would want to predict the stock prices, you would want to predict the demand, you would want to predict weather patterns, you would want to predict pandemic disease trajectories. For everything, you would need time series analysis, because that is the basic foundation on which predictive analytics is built. So while classical statistical models have served practitioners well for decades, recent advances have taken place in the field of time series analysis, like neural networks, machine learning, artificial intelligence, deep learning, neural networks, and so on and so forth. So the advancement in time series analysis is tremendous. And you can access all of this with AI, with generative AI like ChatGPT, Claude, Notebook, and many such. You can always access it as long as you know the concepts. So the understanding of concepts will help you to leverage these time series models so that you can predict with unprecedented accuracy and flexibility. Now, the time series data is different from the conventional type of time series analysis is different from the conventional econometric analysis that we do, because in conventional analysis, we normally assume that variables are independent of one another. But in time series, data is not independent. The current value of a variable, whether it be sales or prices, will depend on a past value. Okay, so such data, which is collected over time and recorded at regular intervals, usually at regular intervals, are called time series data. So unlike the cross-section data, time series have a temporal structure. So what is critical in time series analysis? The date, the time, and how it is arranged. So one has to pay very careful attention to this when they do time series analysis. So here we also presume that the variables are dependent on each other. So time series analysis is a set of statistical techniques used to model, understand, and forecast temporal data. It could be stock prices, it could be the index, it could be sales, it could be production, it could be demand. So the key goal is to uncover the hidden patterns, identify trends and seasonal movements, detect long-term cycles, and predict the future moves. So this is basically what one has to do. And you go about it very systematically, because we have to get a value which is very close to the reality. Like, though we may not succeed all the time, but at least we get a value which will help us to moderate. Yeah. So time series data will tell us whether a particular series is increasing, like is the GDP increasing or is the sales increasing. So you want to use time series analysis. Like certain patterns, like weather patterns, you find weather follows a particular pattern. Certain months of the year, the rainfall is high. Certain months of the year, the rainfall is low. So, and similarly, that same thing applies to sales. It applies to production. It applies to everything. So we need to understand patterns. You use time series analysis. Particularly when you talk about business cycles, you're talking of long term. Now, the stock market, the sensitivity index, or the Dow Jones index, or the NASDAQ has a long-term movement. They don't always move in one direction, either up, down, or constant, but they tend to oscillate. And such economic variables, we need to understand what is the period of the cycle so that we can predict when the next cycle is going to occur or when the next peak is going to occur. And there is also this element of the random variation, which is neither the trend, nor the seasonality, nor the cyclical variation. What happens basically due to news, due to information, due to shocks. Such things are called the random variation. Random variation is also very important because it's believed that the random variation of a series captures the volatility of that series. So therefore, time series analysis provides a powerful toolkit to answer these questions. It helps decomposing the data into its understandable parts and then use it for forecasting, and which will be very, very vital for planning, decision making, and for taking uh, decisions on policy. Now, this is only a flavor. It gives you only the flavor of the applications of time series analysis. It can be the applications of time series analysis will extend depending on your imagination. But just to give you a flavor about where time series analysis has been used, it's used in agricultural economics for forecasting crop yields, for analyzing seasonal patterns in rainfall, to understand crop and livestock price movements and fluctuations. In the area of finance, it's used to model stock prices, it's used to model interest rates and exchange rates and volatility. In business, it is used for demand forecasting, inventory planning, sales trends analysis, and all that. And in environment, it's used to monitor the temperature, the rainfall, the carbon dioxide emissions over time. So it's got tremendous applications, and the applications will depend on how creative you are in using time series analysis. So basically, we start whenever we do time series analysis, and it's something very new to you. The first thing that we need to understand is we need to understand what is the structure of the time series and how is it changing, what we call structural change. So when we refer to structural change, we refer to an abrupt or a gradual change in the relationship between variables or in the behavior of a time series over time. So we basically would start time series analysis by doing an analysis of the structural change to find out if there are any regimes or any periods, distinct periods in the data which we can use for modeling. Structural change usually affects the trend, it affects the seasonality, or it could affect the variance. So if you don't have an understanding of the structural change and you blindly take the data and start analyzing, it could lead to poor forecasting. Because you haven't accounted for that. What the structural change indicates to you is it indicates a regime shift or a policy impact or whatever. So when we study the structure of a series, there are different ways by which we study structural change. One is we can plot the data, do a visual inspection, and looking at the data, we can find out how the structure has changed or whether it's changed at all. Alternatively, you have statistical tests. The statistical tests that you use for structural change are the Chow's test. Then Chow's test will only tell you if there are two regimes. Like you're assuming that the series can be divided into two parts, and you want to know whether the two parts are significantly different. You use what is called the Chow's test. Chow's test is a test for structural change, usually adapted when we are studying two periods. Then you have what is called the QSUM square test. It detects a gradual parameter instability. Then I will demonstrate all this to you. Then you have the biparons test, which detects multiple unknown breakpoints in a linear regression. So basically, you fit a linear regression model with time with a dependent variable, independent variable, and then find out if you can detect any breakpoints. Then you have the Zwick-Andrews test, which allows for unit rest with a structural break. So it tries to look at structural breaks and see whether they are different from each other in terms of their trends. Then there's another test called the Petite test. It's a non-parametric test for abrupt changes in an unknown time. Then you have a rolling window estimation, which fits a moving average to the data. And then looking at the changes in the moving average, you draw inferences as to how the structural series is changing. Now, because our basic objective is to find out, can we detect any change point? And the algorithms that are used are the binary segmentation, the belt, or the Bayesian change point detection can all detect multiple joints with multiple changes, which I shall demonstrate as we go along. So where do we use structural change? Basically, in economics, we use structural change to see if there is any policy change. Now, before COVID, after COVID, before the government introduced a policy, is there a change in the production, the productivity, or the area under a crop? Structural change is ideally suited for that. In finance, you can find out whether the markets have become more volatile, more volatility, or whether the returns have changed, whether the returns changed after a particular change in government or a change in policy. Then in climate, you can also find out, because we are all seized with this problem of climate change, you can find out when exactly the climate change has taken place. Climate change, and at which point the climate or the rainfall pattern or the temperature change. In agriculture, you can find out when the technology, like we had a green revolution many decades ago, how did that affect the productivity? And if there's any revolution thereafter, or what effect it is having on productivity. So product structural change is useful in itself, and it also helps you to identify the cause of a particular action. So you could use it any way you like. But normally the first step in any analysis would be to do the structural change. Okay. Now I think I will just show you how structural change has been done using an example in Python. Okay. Now here is the data. Here is the Python, as you already know. So what I've taken is just for indication. It's not probably the best series to use. Here what I've done is I have taken a series of exchange rate, US dollar versus the Indian rupee. Since the data could not be collected all together, I collected this data from investing.com. So from investing.com, you can get this data, and you can get, because if you don't get a continuous series, you may have to, take it down 3 or 4 times. You can go to investing.com, and you can ask for the series that you want. You'll get the most contemporary series, and which you can then start using. You can use USD INR. You can say something like this. USD. You get USD INR. You can download it, and then you can download right now USD INR. We'll use USDT. This treasury is not exactly. Okay. Let's see. INR. So you could get the exchange rate like this, right? And then you can download it. It's not exactly, this is not exactly. Anyway, I'll just get it for you. You can go here, download it, historical data. You can specify the period for which you want the data. Just go to historical data. And you want the period for which you want the data, you can specify that here. But it doesn't normally give you more than 20 years. So you have to take it. If you want a very long series, you have to set this for a longer period. You have to go this. You can go out. But it doesn't take, so you'll have to do for 2005 till 25. Then you have to take earlier than that. You may have to do it in 2 or 3 stages, and that is why it's minus taken a little bit of time to get. Okay, so here we go. So that's what I've taken USDR1, USDR2, USDR3 to get a fairly long series. So what as we all know, we first start with these basic pandas, numpy, matplotlib.py plot as PLT and OS, mainly to get started. Right? So this is working. There's no problem with this. Okay, there's no problem with this. It's just say so now, since I've got this OS, my data is in this folder called students. So I decide the workspace, and then one by one I import the files. First one I call exchange rate 1, second one I call exchange rate 2, third I call exchange rate 3, and then I combine them all together. Okay, and here I concatenate, because the column names are the same. Then I call it exchange rate and I concatenate exchange rate 1, exchange rate 2, exchange rate 3, and I say drop duplicates because it's quite likely that the series may be overlapping. Okay. And then I want to find out how many duplicates are there. So I use this command, name of the file, duplicated.sum. Okay, because I've asked it to drop the duplicates and it says duplicates are 0. Okay, I really don't want to see the shape. I can just have a look at this file. I can have a look at this file, which is nothing but the master file, which starts from 1999 or down till, so I can look at the head. And then I want to convert this. I told you, whenever you do time series analysis in Python or in R or in any program, first you must ensure that this date is converted into a time object, which it may not be. I can just show you this. If I say exchange rate.info, okay, it will say date is an object. It is not a time series object. So I have to convert it. Okay, I have to get all these are floats, that is price, open, high, low, all are floats. So there's no problem. But the problem, date is not a date object. So in order to convert it into a date object, what I will now do is I'll say exchange rate date. The name of the variable is date. PD to underscore date time. And I want the date and the format is could be whether we combine it from 2 or 3 files. So I first take that and then go back and check whether it has been converted. So I say exchange rate. Okay. Okay. Now you notice that it is converted to date. Another very important thing which we should not take for granted because I'm clubbing 3 files, I wouldn't know which order I club them. So I will first sort the data in ascending order. So I'm going to say file exchange rate sort underscore values based on date. So automatically it will be sorted on an ascending order. It will be sorted in ascending order. And then what I will do is I want only this date and the price. So I do a subsetting which I call exchange rate underscore T, which is equal to exchange rate dot ilog. That is, I want to subset based on the column numbers, which is 0 and 1. Then I want all the rows and I want columns just 0 and 1. So now this takes care of that. Okay. And then what I will do is I will ask it to reset the index because index is very important. Okay. Now what I do is I'm going to do it again. I am going to now one thing that I told you. Now you have the data like this. Look, can you see that? It is 37, 1999, 29. It's in 29, 28. Look, it's in descending order. It's in descending order. Here, that is why I did a sort, and it would have probably become ascending order. It should be in ascending order. So therefore, I've done it over here. So if I look at the values here, if I look at this, you'll notice that it is in ascending. Because that's very important, because if you don't do that, it will sometimes analyze data which is in the descending. Okay, it's any order. Now it's come. Look, it is 26. Look, now it is, look, it was 99. That got mixed up. 26, 12, 79, 27, 12, 79, 28, 12, 79. Look, now there are 2 days off. 29, 30th are busy. That is Saturday and Sunday. So we have to tell the computer, because before doing the analysis, you must tell the computer, this is a series which is daily data with only weekdays. So what you do is you go to ChatGPT and give that specific. You say, for this file, you want that change. It does that for you. Okay, so what is done? It's okay. Now I'm going to call the file data. This T, I'm going to call it data. And I'm then going to call it DF, and I'm going to convert it into a data frame. And then, of course, I recheck and I make the data into date time again, just in case, doesn't matter. And then what I do is I put this into the index. So when I put a variable into the index, it will go 1 step down. You'll see that later. It'll go 1 step down. Okay, so that's not visible over here. So I'm telling the computer, make the date the index. Okay, and then you create a database from minimum to maximum. Frequency B means only weekdays. Capital B means only weekdays. Okay, Then I say reset the index range because date will go into that. Reset the index range, and then I want to call the index name date, and I want to print the DF. You will just see that in a moment what it has done. So now what it has done, it is created date in an index. That's why it's got one step below. Now you'll notice that all the days are there from the first day of your series till the last day of your series, with Saturdays and Sundays omitted. Now you see there is a day here where there is no data. So 26, 27, 28, 29, 30, 30 and 1st of January was a holiday. So that it makes it. So if I start eliminating all the missing values, my whole series gets distorted. So it won't be a 365 day, oh no, sorry, 260. That is 52 into 5 is 5, 5 to 13, 25, that's 6. So it will be 260 days. It should be 260 days. So this command, set of commands helps you to do that. So your data becomes absolutely, what do you call, what do you call it? Its integrity is very high. All the days, only 5 days in a week. Otherwise, what it does is it makes the Mondays and Tuesdays into Saturday and Sunday. So the computer by default assumes there are 7 days in a week. So this minor manipulation you should do depending on your data. If your data is weekly, 6 days in a week, then you have to make the appropriate changes. The codes for that you will get from ChatGPT. Okay, now I've got a series. I've got a series which is running continuously from the first day of my series to the last day of my series. I just want to check because here now the missing values are corrupted. Because of this operation, missing values are corrupted. And now this is how I check how many missing values I have. Name of the file is DF. You may remember that I changed the file to file name to DF. So the missing values df.isnull. Open and bracket, close dot sum, open and close a bracket. So I get this one. And what it says is you've got 116 missing values of this because all the holidays, Christmas, New Year's, everything becomes holiday. So that has to be treated accordingly. So I've got 116 missing values. Now I can interpolate that missing values very easily using a linear interpolation by just using the command df to the name of the file to interpolate. That means all the variables in the file will get interpolated. In place is equal to true means please retain the changes. Right? I've done it and now df looks different. Now you'll notice that df has noticed. Now this has to be done because handling missing values in time series analysis, particularly in R and Python, creates a lot of problems. Right? Now what I'm going to do is I'm going to call my exchange rate T. I'm going to call it back. I'm going to call exchange rate T as df as exchange rate T. Another way of renaming the variable. So now I'm going to do a plot. So for that, I do a PLT, which is what I invoked in the beginning, PLT.plot. You may notice that PLT, I got this PLT from here. I got this PLT from here. So this is the program. Matplotlib.pyplot is the program for plotting graphs. Okay, so I've done that. So I've done it. Okay, so I'm going to the PLT.plot. Since data is in the index, I don't have to specify it. Normally, when I give a PLT plot, first I must specify what is X, and then I must specify what is Y. But when the data is in the index, as you see over here, it's in the index, then it doesn't have to be done. You just have to specify the Y, exchange rate price. Then I give a title PLT. Temporal price changes in INR versus USD, and per USD. And I say, please put the label on the top. So what it does, it plots it. That is how my series moves from 1980 till 2020. So you may now appreciate why I took 3 files rather than 1, because when you use investing.com, you don't get more than 20 years at a time. So I had to take it thrice. That's why you had exchange rate 1, exchange rate 2, exchange rate 3. Now I have a series, very clear series, which moves from 1980 till 2024. Very, very recent data, which I just. Now, very often what we do when we do in time series analysis, we need to convert the frequency of the data. Now, the data that I've got is weekdays daily. I want to convert this weekdays daily into monthly data. So the precondition for that is first the date should be in the index. It's already in the index. And once the date is in the index, I can, I'm doing it again, just say reset index in place is equal to true. And then I say, first I must reset it, and then I'll set it afresh. I'll say make date as the index. I do it twice because sometimes it's in date. it'll create a problem. So once date is in the index, then I can convert this to any frequency I like with just a simple command. I give it a new name. I call it exchange rate weekly. Let me first show you how you convert it from daily to weekly. Then I say x rate, this is the name of the file, dot resample. And in bracket, I put W. And if I get to put a mean, for that week, it'll average out the price. It'll average out the price. Now it's going to give me the weekly prices. Now you can see this file, no? And the name of the variable is fine. I want it in green. And I want all the titles. This will be familiar. And now my data is now weekly. It more or less looks just the same, just that it will be a little more smooth because it will average out. I can also use the last value, for which case I'll put last. I will show you that as I do this. Now I want to convert the same data into monthly. I don't want to convert this to monthly. I want to convert the original data, the daily data, which I got over here, exchange rate T. I want to convert that into monthly data, ensure that the date is in the index, and then I create a new variable called exchange rate underscore M, exchange T. This here I'm going to say resample is equal to month because it's monthly. And then I will say I want the last value. I don't want the mean. Give me the last value of each month. That is the 30th. I've got it. Right. And now if you want to look at that, if you want to look at the size of the monthly data and the size of the weekly data, you will get it over here with just the shape. So there are 542 observations when it's converted to monthly, 2,353 observations when it's converted, when it is in the weekly form, obviously. Now we're going to work with the monthly data. I will need to, because when I do this manipulation last and all, I could quite likely that I could create missing values. I'll just check it anyway. I'll just say, this is a command. Name of the file, .isnal, open and close a bracket, .sum, open and close a bracket. It tells me that none of the variables have any missing values. Now I'm going to show you how I do the structural change. Okay. So structure change in a time series, what I do is I first look at the first thing what I told you, look at the graph. Visual inspection. First look at the visual inspection. So I'll make a graph. As I told you, I'll plot the exchange rate. I'll give it a title and I'll run it. Exchange rate monthly should be the name of the variable is not specified. So when you specify the variable, I should put this. Okay, name of the variable is always in brackets. And we've already seen it. So the monthly data, I plotted it. And you can see that roughly you can make out visually that there could be one structural change here around 2003, because then there could be another structural change here when it became flat. It's increased exchange rate. That is, the rupee got devalued between 80 till 2002 quite significantly. Then it was fairly stable from 2000 to 2010. And after maybe up to 2010, 12, and after that again, rupee started getting devalued. So you're able to identify specific regimes in this data. Now, how do we do it? Okay, so what I do is I don't have a time variable in this series. So I'm going to introduce a time variable, which is just a number running from what this, of course, date is there. Data is not a number, so I won't be able to use it. So what I do is I'll take a time variable from this, which I'll call 1, 2, 3, 4, 5. And how I do that is a simple command, okay, which you should know. That is like, so I'm creating a new variable in this exchange rate underscore month. The new variable is called time. And how I get the time variable is using a command np, that is numpy dot a range, not arrange. There's no double R, a range. Give the name of the variable. And when I say shape, it gives me the number of rows and the columns. I want only the rows. So for that, I put 0. As you already know, Python starts counting from 0 and not from 1. So when I get a combination of values, the first value is 0, which means it gives me the number of rows. So it's going to give me a column that runs from 0 till the length of the file. So I do that. And I convert it into data frame and I look at the data and you can see the new variable has been created. The new variable has been created. Okay. So now I am now going to fit a trend to this. So I'm going to now find out the breakpoints using, I'm going to find out the breakpoints using Chow's test. Chow's, yeah. So that's regression was not invoked. So now what it says is the Q-sum's test is 4.07 and it is highly significant. So there are two distinct groups in the data. So we're not really interested in two distinct groups. We want more than that. So here we use the next test, which does a breakpoint. We are using the PELT, change point detection using PELT. So these are the codes. It takes a signal from this. And this you can get it directly from ChatGPT because if you just ask it what is true, what will be done. I'm going to focus only on the interpretation and then I just run it. So, it says there's one period which runs from 1980 till about 1992, maybe till 1992. That's the time when India went in for reforms. Then from 1992 till about, this will be till about 1998, it was fairly stable. Then from 1998 till 2004 or something, it went up. And this whole period is from 1998 probably till 2014. There was a fairly steady exchange rate. It did not increase. It did not decrease. And then after that, after 2014, you found there was a steep increase in the exchange rate. And from 2020, there's an even steeper decline in the exchange rate. So you've understood how the exchange rate has been moving in India versus the dollar and what were the different regimes. Okay. So this kind of gives you a first-hand idea as to how to do it. Okay. So this is basically what you will do in structure change. Right. So now we go back. Now we've understood the structure of the series. Okay. So we can be dividing it into 1, 2, 3, 4, 5 periods, and which year the period started and ended. Also, we can identify with just these commands. I share the codes. You can use it. Okay. Okay. So these are the different methods. Now, whenever you analyze any time series data, what you should remember is in that time series data, there are 4 components. And what are those components? A trend component, which shows whether the series is increasing. The seasonal component, which gives you the pattern. The pattern can be how does the pattern particular sales have behaved during the year. A company like Pepsi or Coca-Cola want to know how their sales are taking place different months of the year. Or a retail outlet wants to know what are the sales pattern in the 7 days of a week. So that's a seasonal pattern. So seasonality measures patterns, which tend to be repetitive. Cyclical variation measures the long-term variation. Business cycles. You want to study stock market and see what is happening. How long does a bull run boom from one? The cycle is a period from one boom to another boom, one peak to another peak, or one trough to another peak. And the last component is a random variation, which is called the irregular variation, which we discussed earlier, which is also part of it. Okay. Now, if I want to know what time series analysis does, it estimates each component separately. And it gives you an insight into what is a trend. Now, what is the utility of the trend? Trend is very useful when you're making any long-term forecast. Now, if you want to know what is going to be the exchange rate in 2029, you would normally use a trend. You'll see where does a trend reach. Because always a series has a tendency to return to its trend. So that is the significance of the trend. Seasonal patterns are short-term variation, which happen every year, which repeat, and it's useful for decision making. Cyclical variation are the long-term movements. We need to know how it's moving, so like that. Now, when we put all these together and then we analyze, we get another model called the Holt-Winters model. We get a model called the Holt-Winters model. The Holt-Winters model is also a very powerful time series model, which combines all these 4 components, and then you can use it for forecasting.